Here in this video, we will be going over some breaking news for Tesla stock. Not only that, what market participants, analysts, and big money are saying about this CPI report that came out and what's coming next for Tesla stock. I think that's the bottom line that most of us want to know, as Tesla has been red 9 out of the last 10 days. I can't think of a period of time that you have seen so much red besides back here when Elon was selling stock in December of 2022. Let's go ahead and jump into it. Tesla says we are forced to suspend vehicle production in Gigafactory Berlin, Brandenburg, from January 29th to February 11th, with exception of a few sub-areas. Tesla says this is due to the armed conflict in the Red Sea and associated shift in transportation routes that is having an impact on production in Grünheide. I mean, this sounds like bad news, but Tesla's stock actually bounced as this news came out. And why is that? Well, on one hand, Tesla deliveries are probably not going to look so good for Q1, that's a certainty. This is not going to be fantastic, but it does mean the cost should be lower. And if Tesla can run through their almost 100,000 vehicles of inventory, well, maybe deliveries don't look as bad, and maybe that's actually a huge positive for margins. Now, I firmly believe never shutting down a factory is ever going to be good news for Tesla, but the stock thought otherwise. Let me know what you think about this news down below in the comment section. Now, for Tesla's stock, if you actually take a look at the stock here on the chart, what a disaster show it has been in 2024. Over the past 10 trading days, Tesla's stock has only been green on January 8th, and you were up 1.25%. Every other day out of the past 10, you have been red. And today was another 2.5% red day. Now, in this same time period, you have broke under the 100-day moving average, the 50-day moving average, and the 200-day moving average. It has been rough for Tesla stock investors in 2024. And I think some people are getting overly pessimistic about Tesla. I think that is a potential risk for those individuals. I'm not going to get in that camp, but I will acknowledge things don't exactly look fantastic. You have officially filled the gap. As you know, all gaps need to be filled. That has officially happened today, and Tesla stock bounced right at that level. In the short term, in the midterm, that seems like a positive. Hopefully we get stopped out on this decline. You should be seeing quite a bit of demand in the high 220s and even into the 230s when we actually do get a rebound, in which I think we will get a rebound. Now, your 200-day moving average sitting at $231.19 per share, that's going to be your big resistance. If you can break above that again, if it's not big resistance for whatever reason, that's going to be fantastic news. But odds are you could stay in the 220s until something changes in the markets. That change could be coming tomorrow, because we are going to get earnings reports from JP Morgan, United Health Group, Delta, Bank of America, Wells Fargo, BlackRock, Citi, and BNY Mellon. Now, if these bank earnings are good, fantastic. It really has little to do, though, with the earnings themselves. I don't think bank earnings are going to be so good or so bad that it moves the markets. What can move the markets is bank commentary. So if we get Jamie Dimon with JP Morgan coming out and saying, hey, the consumer is really struggling, they're starting to default, things don't look good, markets are not going to like that, right? If the contrary kind of language is spoken, that the consumer is doing okay, we're seeing signs of a rebound in consumer spending, something along those lines, stocks should perform well on that. These earnings will be coming out around 8:30 in the morning, and then you should be getting the conference calls for most of these banks starting at about 9:30. So the markets will actually be open for trading as we are getting the headlines coming through. So if you guys want to come join the trading community and see those headlines when they are being posted and be able to react to this information live in real time, check that out, link down below in the description of this video. Unfortunately, I don't have high hopes for what the banks are going to say. If you take a look at this post from Game of Trades, bank credit is contracting for only the second time in 50 years. Let that sink in. So banks are literally withdrawing the amount of money they are letting people have access to. That's not great. The only time this has happened was during the Great Financial Crisis in 08 and 09. And you are yet again contracting. You're almost down about 3%. This is either a sign of one of two things or both. Banks are not doing well, number one. They need to keep as much capital as possible. Or they suspect the economy is going to get worse as they're seeing people's bank accounts activity getting worse. And they're trying to beef up their balance sheets in case that happens, minimize some losses. As you can see from this chart, the year-over-year change in credit defaults for the top 20 US banks that provide credit cards is up 12.7%. You can see with JP Morgan, about 2% of all of their credit card loans are delinquent. Citi is at about 3%. Capital One is at 5%, Synchrony Financial at about 4.5%. Most of these banks are in the high twos. TD Group is at about 4%. Merrick Bank is at 12.28%. I don't know who they gave loans to, but that's not great. Barclays at about 3%. You get the idea here, right? It doesn't look like people are doing well. And that's quite a problem. It looks like over $1 billion is currently in default with credit cards. That's a bit of a problem. And it looks like it's not getting better anytime soon. This could be another reason why banks are pulling back on the amount of credit they are letting consumers have access to. You can also see the M2 money supply is contracting at speeds that have always experienced a negative economic outcome. You can see here that every time you see the M2 money supply contracting, it's been something, not great. Even, more recent times like the banking crisis or like the Great Financial Crisis in 07-08, you still didn't see that M2 money supply contracting like you are now. The last time you've seen that actually happen, you have to go back to 1937 through 1938 recession. The Fed double reserve requirements as they tried to soak up excess reserves. Not great. And then for a brief period back here following World War II, 1948 through 49, you also seen a slight contraction, but that's kind of alarming. I'm not gonna lie with you guys. I try to be as bullish as possible because I don't see as many dangers out there unless we get a central catalyst for a recession. I still don't think it's going to happen, but when you have all of these statistics and stats and charts starting to, paint this picture, it's if we truly avoid a recession, there's going to be a lot of firsts here. Right? There's going to be a lot of first times for everything. The yield curve, this would be the first time the yield curve has been inverted this long. If we avoid a recession, well, that would be unprecedented. The M2 money supply shrinking, that would be unprecedented. Bank credit decreasing. We've always only ever seen that with a recession. It would be unprecedented if we avoid a recession. So even though I don't think a recession's coming, you have to be prepared for one regardless. Good news is it's a presidential election year. It's basically political if you go into a recession, okay? Not great at all. There's only ever been one president that has won a re-election during a recession or within 2 years of a recession happening before the election, and that was William Taft in 1913. A lot has changed since 1913. A lot of people just blame the president in charge for the problems in the economy, which some of that blame does have to do with the presidency as well if you go into a recession. But that's the reality of it. So I think the Fed would cut rates very, very low, like to zero, before risking a recession in 2024. That is maybe a little bit of reassurance. ECB's President Lagarde says, I cannot give a date as to when interest rates may go down. And Fed Barkin says, I am opening to lowering rates once inflation is on track to 2%. The messed up part about all of this is inflation is indeed on the path to 2%. We've been on the path to 2% for a while now. The only problem that I think we could be facing here pretty soon is the Fed not cutting rates fast enough or not cutting rates soon enough. That is an existential risk to our markets and to Tesla stock that I think is actually starting to get priced into the markets. I mean, after all, what other conclusion do you come to when you get a slightly hotter than expected CPI report and the odds of rate cuts jump dramatically? So for the odds of 6 rate cuts, that has went from 38% yesterday to 40.9% today. The odds of 7 rate cuts yesterday, get this, 21.1%. Today, 34.3%. You have jumped 13% just day over day for your odds of 7 rate cuts. You're almost pricing in 7 rate cuts again. Even though inflation was slightly hotter than expected, I think the markets are starting to say, hey, Fed, wake up. You need to start cutting rates. The bond market, which sets probabilities for Fed policy, is typically correct. There's really never been a time where the Fed has been correct in their forecast over the bond market. The bond market is even better than the stock market. Stocks could be ripping, going straight higher, and you could be crashing face first into a recession. The bond market will tell you that. Stocks, not always. So when we're looking at the bond market and pricing of Fed policy, I think the bond market is starting to say, Fed, you have to start cutting rates soon. Personally, I was hoping for a better than expected CPI report today. That could have set us up for a rally into the end of this month when we get to January 31st and the next Fed rate decision. The problem here is you would expect, with a hotter than expected CPI report, that the markets would unprice in, or at least start to unprice in, the March rate cut odds. That's not happening. You got a slightly hotter than expected CPI report, and the odds for a rate cut in March went higher. That should not happen, okay? So if the Fed does not listen to the markets coming in March, then I think we have to revise our recession forecast at least somewhat. There has to be a higher likelihood of a recession if the Fed does wait until, if we don't get a rate cut in March, we're not going to get one at least until May. That could turn into a bit of a problem. Now, here on the day today, the odds of a rate cut starting in March to get one rate cut is 68.3%. The odds yesterday was 67.3%. That is kind of strange. If you look at 10-year Treasury yield as well, what the heck is going on, guys? This is telling you something, right? 10-year Treasury yields are down almost 5 basis points on a hotter than expected inflation report. On a hotter than expected inflation report, bond yields should be rising. I don't know how much more obvious this can get. The Fed's not exactly being dovish today. They're being quite hawkish today. And the bond market's like, nope, screw you. Heading into a recession, some kind of downturn, you're going to have to cut rates. I don't know. Let me know what you think down below in the comment section. That is another reason why I think bank earnings are going to be so important. Again, not the numbers themselves. Who cares about the profits? Who cares about any of the other crap, okay? Bank earnings are not going to move the broad markets like that. But what will move the markets is, again, what the banks have to say about the consumer and about the economy. Maybe that's why the bond market is reacting as if we got a good CPI report today. I honestly don't know. I don't have a good answer for what is going on today. And that's a little concerning because given what we've seen, this should not be happening today. We do have a new AI investor sentiment survey that is out. Really not changing much at all from the last one that we got. Still 48.6% investors that are bullish, 27.2% of investors that are neutral, and 24.2% of investors that are bearish. These charts are almost identical. There's a little bit less neutral investors and a little bit more bears. But other than that, Nothing's really changed. Now take a look at this. This is insider buys / sells. This is the ratio of the United States overall market. This is CFO, so chief financial officers. And you are at some of the lowest levels that you have been, you know, in recent times. Okay. Not a lot of people, CFOs specifically, are selling their company's stock. That's a great sign, at least right now. If there are going to be problems, you would see CFOs, CEOs selling stock. Same thing with CEOs here. You're on the lower end range of normal. Insider just buying / selling, the ratio in general, again, you're on the lower end of normal. So this actually is a pretty good sign, because what you tend to see right before a recession is a lot of selling. You could see during these periods, or even just periods of recession fears, you tend to see a lot of selling, and you're far from that right now. So this is kind of in contrary to some of the other things that we've talked about here in this video. This looks pretty good so far. But just as a reminder, so none of us are confused, the typical S&P 500 during an election year, well, doesn't do much in the first 3 months of that given election year. It's really towards Q2, Q3, and then really after the election itself that markets tend to do very well. Now, in the more near term for Tesla, you almost have to expect a bounce, right? At least at some point over the next couple of days. Tesla's RSI is 36.85. Just for a little bit of context here, the S&P 500 has an RSI of about 65. So Tesla's RSI is almost 30 points lower than the S&P 500, which is off the charts ridiculous, okay? So you are very oversold here for Tesla stock. I know a lot of people are discouraged. We thought 2024 was gonna be good, at least in the beginning, because people had to get back allocated to markets. People had to get back into stocks, into interest rate sensitive names made the most sense. I think what you're actually seeing though, part of the reason why Tesla cannot catch a break, Q4 deliveries were good. We've gotten more good news than bad news in 2024. I think the biggest thing is markets are getting fearful of a recession. And that's why Tesla is not doing well, because if we go into a recession, well, don't expect Tesla to do well. Fundamentally, people don't buy new vehicles during recessions, right? If you lose your job, you're not in the market to buy a new vehicle. I think that's what's actually affecting Tesla. And I think the Fed is trying to talk a tough game, but they have no bite at all. So we'll see what ultimately happens, but I do think we are set up for a bounce here in the near term with Tesla, unless something is disastrous tomorrow with what the banks have to say about the US economy. You're probably set up for a bounce, maybe coming tomorrow, if not the start of next week. If you get above the 200-day moving average, things look a lot better. Then you're probably going to be in this demand zone between 230 and 240 for a while. Tesla does not report their earnings until January 24th. So you still do have a solid, a week and a half of trading before you get Tesla earnings. Tesla earnings could be the next big catalyst to send Tesla stock higher or lower. I mean, Elon really has to walk a fine line, though, with this upcoming earnings. He cannot be overly pessimistic, or Tesla stock will fall even more. I don't think Elon cares what happens to Tesla stock, at least in the near term. So that could set us up for even more downside. If Tesla does start to fall to about $200 per share, that would be a big buying point, in my personal opinion. And I think if we get down there, it's based on recession fears, right? I think the recession narrative is starting to creep into our market in certain sectors, in certain stocks. It's not being reflected in the S&P 500. That's because your average stock, well, not your average stock, but the stocks that control the average index move, right? Like an Apple and Microsoft, and Google and Amazon, they're not as sensitive to the economy compared to Tesla. But you've also been seeing a lot of carnage in other small cap stocks as well. And I think that's ultimately why small caps have been way underperforming in 2024. As you can see here on the day today, you're seeing a big drop of stocks that are now under their 50-day moving average. You're down about 4.5% to 71.5% of stocks above their 50-day moving average. That is, lower. That's kind of where you were in the month of July during the AI rally. About here at about 71% of stocks above their 50-day moving average. And again, if you look at small cap stocks, they really have not been doing well, okay? If you take a look at Fubo, just for context and example, stock's not been doing well. If you take a look at SoFi, stocks have not been doing well, okay? It's not just Tesla, but it's sectors that are sensitive to an upcoming recession, if that does happen. Now, the only problem, again, with a recession is we just don't have that central catalyst that causes it. Typically, there's always a catalyst that causes the recession to start. We don't have that. Not to say that couldn't happen, but we just don't have that as of right now. So let me know what you think about this information. Tesla stock, if you don't get back above the 200-day moving average, things get really rough. Potentially down to about $200 per share, especially if the markets start to take a down move here. The S&P itself is trading at pretty much all-time highs. You just hit new all-time highs today. If you were to get a down move in the S&P, that's going to be reflected, extra in Tesla. So that's a bit of a problem as well. Right now, I want to have some cash on the sidelines to be able to buy some great companies, some fantastic deals if we do get further downside. Either one of two things happens here. Either stocks panic about a recession and fall, and you continue to see Tesla do poorly, or the recession narrative goes away, and likely your S&P and NASDAQ, triple Qs, SPY, ETFs start to kind of trade sideways, not doing much of anything, and you see a recovery of small mid caps, interest rate sensitive names, economically sensitive names. Let me know what you think, which one is coming down below in the comment section. That is going to go ahead and do it for this video. Hit the like button as well as subscribe to the channel. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.